Okay, so today we're going to talk about Wyckoff Theory. Wyckoff Theory pertains to smart money, so let's go ahead and get into it. So, what is Wyckoff Theory? Wyckoff Theory focuses on the concepts of accumulation and distribution. It is used to understand market trends and the intentions of institutional players. So, basically, it focuses on analyzing price and volume patterns to identify the intentions of large institutional traders. The theory suggests that the actions of these smart money players provide insights into the future direction of a particular security or market, right? Now, market manipulation. Wyckoff believed that market manipulation by smart money participants was a common occurrence. These players intentionally create deceptive price patterns and false market movements to lure in suspecting traders before executing their intended direction. So, these market participants, they leave these footprints of in the form of price patterns, volume characteristics, and market phases. And then, we can then analyze those and observe them and gain insights into their trading activities. So, all these moves that they intentionally create, um, you know, using these footprints of forms of price, pattern, volume characteristics, all that good stuff can help us, really gain insight into what they're trying to do, right? Now, Wyckoff method. It involves analyzing price and volume patterns, market structure, and investor feelings to identify potential buying and selling opportunities. So, like I said, you know, we're we're looking to get into the minds of these investors and the big money, the smart money, and exactly what they are going to do, right? We're aiming to identify areas of supply and demand imbalances, breakouts, and potential reversals, and that enables us to then uh, enter exit trades at favorable points. Right now, there's three Wyckoff laws. The first one is supply and demand. When demand is greater than supply, price rises. When supply is greater than demand, price falls. So when you have in your the market, you see all this accumulation happening, right? And in this accumulation is all these contracts. And when all these contracts are bought up, because there's not an infinite amount of contracts, right? So when all these contracts are bought up, either there's too much being bought or there's not enough being sold, right? And so when you know there's a lot being bought, think about it, in a company, when something's being, a product is being bought a lot, you're going to want to raise that price on that product because you know that it's in demand, and then that price is going to rise. And vice versa, if that product isn't doing well, you're like, I need to get sales in. You're going to want to lower that price, right? If it's at $10, you're going to like, okay, I'll lower it to 9, see if people will buy at this price, right? So that's the law of supply and demand. Now, the law of cause and effect. This can be seen as the force of accumulation or distribution within a trading range, as well as how this force works itself out in a subsequent trend or movement up or down. So eventually, during consolidation periods, there could be too much supply and there's not enough interest in buying contracts, right? While if there isn't enough interest in buying, price is going to go down. But if there's enough interest in something, price will go up. And it reminds you, there's a million opinions out there in these markets, and people are basically fighting over these contracts. One person can say, I'll pay $100 for this. No, I'll pay $200 for this. And they keep toppling over each other, right? And so when there's too much of demand and not enough something of supply, like I said, price goes up. And when there's not enough demand and too much supply, price goes down. Now, when supply and demand is even, now you get accumulation and distribution phases. And that's when these markets move in phases based on the willingness for someone to pay for something or not, or the willingness for someone not to pay for something until it gets to a certain price, right? And eventually, the contracts in the accumulation are being bought up. And once each contract is bought up, the price will start to break out until no one is willing to pay such high pricing. And when no one is willing to pay the price, then it starts going sideways again, right? Now, the next law is the law of effort. This provides early warning of possible change in trend in the near future. Divergences between volume and price often signal a change in the direction of a price change, right? So like I said, when price starts going sideways again, and people are putting their take profit above the highs or below the lows, and it doesn't hit their take profits, they start moving price down in order to get their take profits hit. And so, as well as people who are trying to sell are doing the same thing as well. And that's when price starts breaking down. And then once that happens, the markets move in phases, and they allow time to pass. And when time starts passing, pending money is being placed literally everywhere in between that accumulation. And everything is buys and sells. And this is literally what smart money needs to accumulate, is for time to pass. And so once all this time is passing, money will accumulate in this consolidation. And what is basically pending above and below these, structure points of accumulation is supply of contracts, right? And so the more that time has passed and prices stay in the same area as consolidating, the more pending stops are placed. And so the more equal highs and equal lows that are there, they will start to not withstand those highs and lows. Will start to break them. And then that right there is exactly what smart money needs to play. And so once time will pass and money will accumulate, it will start to accumulate above the structure of the accumulation and below it. And that's when those pending orders are placed, right? And those orders are literally a supply of contracts money. So if you have equal highs or equal lows and you look for M's and W's, once you see that the price spikes above the equal high or the spikes below the equal low, that's that's the smart money going to get those pending orders that are down there, so then they can reverse it. Next thing is the volume analysis, right? Volume acts as a confirmation or divergence tool, helping traders gauge the strength or weakness price of movements. An increase in volume during a price breakout, for example, can validate the bullish and bearish bias. So everything's a buy or sell, right? Everything's a buyer or a sell. What happens before the market expands is that there will be a rapid high or a rapid low created. And once that rapid high or low is created, that's when you can tell that reverse is going to happen. Like I was saying, if you're looking for an M or a W, and then you see that last leg of that M or W, and then all of a sudden you see this huge spike up, that is what is happening before the market reverses. And why that happens is because there's literally liquidity up there. There's a pools of money. And so after that upthrust, after the distribution is all cleared up there, um, it clears all those pending orders above the highs and the lows. That's where the big money, excuse me, that's where the big money gets in. That's where smart money comes in and takes their positions, right? So, some additional notes. The price moves from one point to the next based on the willingness to pay for something or the willingness to not pay for something until a price is at a certain price, right? So, that is how price will move up and down. Basically, it's based off millions of people's opinions and who is willing to pay for more, and they start to topple over each other and then buy. Once that happens, then decreases the supply at certain prices, because there's not a certain amount of infinite contracts, right? So that's when then the price breaks out because there's no more willingness for people to pay at that price. Another thing is that on the smaller time frames, it's making higher highs and lower lows, etc., etc. But on the bigger time frames, what that actually is, that's the whole entire market accumulating. That's the consolidation, right? When consolidation or accumulation is happening in extreme areas, maybe way below an obvious low, maybe on the daily, weekly time frame, price will hover around that area, then it will dip below the obvious lows or dip above the obvious highs, where everyone would end up putting stop losses, and then that's where the big money would come in. All right. And in conclusion, supply and demand dynamics are central to Wyckoff theory, helping traders identify areas of support and resistance. Patience and discipline are emphasized, waiting for confirmation signals before making trading decisions. Also, understanding the intentions and actions of large markets participants is crucial for success application of Wyckoff theory. All right, so that's all on Wyckoff theory, and I appreciate y'all for listening.